Welcome in. Welcome to another edition of Market Takes. I know you could have been anywhere in the world, but you're here with me, and I appreciate that. I'm your host, Dion Rabouin, reporter for the Wall Street Journal. This is Market Takes, and this week we are taking you through the three most important things you need to look out for this week. We got a lot of data coming up as we prepare for our last week before we get into the Federal Reserve's FOMC meeting next week. So I'm going to tell you what the three biggest reports are going to be this week. First off, we've got April consumer credit coming out on Wednesday. We get mortgage rates on Thursday and then initial jobless claims that same day on Thursday. Now, those aren't generally thought of as big reports, but ahead of the Fed, ahead of CPI, ahead of retail sales, all coming out next week. I'm going to tell you why you need to watch out for all three of those reports and the effect they could have on inflation. And as we know, that is all the Fed is looking out for right now. So first off, let's talk through this April consumer credit report. Now, that usually gets released, or doesn't usually, that gets released a little later in the day. It's at 3 p.m. on Wednesday. March, we had a jump of $26.5 billion. And for April, we are expecting another jump of $21.6 billion on the increase. Really, that without context, that doesn't mean a whole lot. So let me throw a chart up here on your screen so you can just see what we're looking at when it comes to credit card increases. Now, as you see up there on your screen, just a big increase, and you see that spiking number as we get through 2021, 2022, and then 2023. So 2023 has even risen faster than previous years. And there is a particular data point I want to talk through, but just looking up here on your screen, you can see that big defined pickup that really outstrips the previous increases that we had seen in other years. You're just seeing that spike being a little bit more vertical than it has been. And that chart just illustrates what we have seen in terms of Americans taking on credit card debt. Now, a very interesting fact that I haven't seen talked about very much is for the first time in 20 years, during the first quarter of 2023, Americans did not reduce credit card spending. We have seen a consistent theme of Americans build up a lot of credit card spending in the fourth quarter. Obviously, that's holiday time, gift giving, flying back and forth, travel to see family, et cetera, et cetera. But then in the first quarter, consistently over the past 20 years, Americans reduce that credit card debt. They pay it down. In the beginning of the year, we did not see that. And in fact, we saw Americans taking on more credit card debt in the first quarter this year. And that theme looks to have continued into the second quarter. Now, usually, like I said, you get your tax refund, you pay that down. So the things beginning of the year, tax refund season, those things usually go in hand with a reduction in credit card debt. This year, we have seen an increase in credit card debt and actually an acceleration of the increase in credit card debt. This is suggesting that some households are under strain from these higher prices, higher inflation, and are likely relying on credit cards to maintain their spending. So we have seen retail sales last month, we saw a pickup. We've seen spending, especially on services, pick up. And a lot of folks are saying, okay, well, that means the economy is healthy combined with the jobs numbers that we've seen. But what it likely means is a little bit of that psychological effect of folks are saying, okay, well, I got a job. Job may not pay enough for me to afford all the things that I want, to buy the things that I need, but I've got the job. So let me go ahead and take out money on this credit card. I'll buy things on my credit card paid off later. Well, those balances are just getting higher and higher and higher. Interesting fact, follow with me, I'm going to throw a bunch of numbers out here, but follow along with me. 2018, credit card debt rose 4.2%. 2019, credit card debt rose 3.5%, again, year over year, right? 2020, pandemic year, credit card debt declined by 10.9%. Then 2021, credit card debt rose by 5.7%. 2022, credit card debt rose by 17.4%, and we are on pace in 2023. In March, we had 17.9%. In April, we had 13.6%. Now, look at this chart again. Let's throw this chart up here on your screen one more time, and you see that define that very clear acceleration in credit card debt. And we are just seeing a huge, massive pickup, and that's showing no signs of falling. It is reversing and defying historical norms and just really picking up. So that chart illustrating, again, just this unusual change that we have seen in credit card borrowing that I think is going along with the increase in jobs numbers that we have seen. That is unusual. Usually as folks get jobs, they got more money, they're paying down credit card debt. What we're seeing instead is people taking on more credit card debt. We're also seeing delinquencies rising back to pre-pandemic levels. So folks not being able to pay off that credit card debt they took on. And we know that credit card interest rates are at a record high, well above 20%, by some measures up to 24%. So this is again defying historical norms and at a time when credit card debt is the most expensive it's ever been. Now look, want to talk about another piece that plays into that debt puzzle, and that is mortgage rates. Now take a look here at the Freddie Mac mortgage rate data. Now we are seeing those mortgage rates again approaching 7%. When mortgage rates first started picking up in 2022, you saw home sales decline, really dive, fall off a cliff. But lately we have not seen that, even though we're seeing this up and down in mortgage rates, increasing, decreasing, but as the 10-year treasury yield has risen, it's around 3.75% right now. You see there at the edge of your screen on the right side, mortgage rates starting to pick back up. Now, that chart just illustrates the overall trend of mortgage rates. And what we're seeing is housing buys of new homes and existing homes starting to pick back up again, defying even these higher rates. So even as rates have come down and picked back up and sort of stayed around the same level they were at last year, we are not seeing consumers turning down borrowing. And actually, the Fed is starting to worry about this. We've seen Fed Governor Michelle Bowman just last week say, quote, "While we expect lower rents will eventually be reflected in inflation data as new leases make their way into calculations, the residential real estate market appears to be rebounding, with home prices leveling out recently, which has implications for our fight to lower inflation." That's Fed Governor Michelle Bowman talking about, hey, we think this could play into our fight against inflation. We want to lower inflation. We're keeping rates high. That's choking off growth for businesses, but folks are taking out that debt on the consumer side in credit cards and in terms of mortgages. So that chart just, like I said, illustrating that folks are not turning away from mortgages even as these rates move higher. Last chart I want to talk to you about is the initial jobless claims. And what we're seeing, we saw this surprisingly strong jobs report data on Friday, and we have seen initial jobless claims really surprise. I want to put up here a chart on your screen now that shows initial jobless claims. This is not seasonally adjusted right here. You see that big spike at the beginning of the year, and we've seen the numbers kind of pick up and fall down, but you're seeing big spikes and pickup when the data is not seasonally adjusted, right? You see a boom pickup. Oh, okay, that could be worrisome. Now I want to put up here on your screen the seasonally adjusted, right? When smoothing out that data, well, it looks a lot less worrisome. You're seeing a lot lower numbers, and consistently the trend is much more consistently low than it has been historically. And again, the Fed wants to see more jobless claims. The Fed wants to see more folks filing those unemployment claims because that's going to slow the labor market. That's going to slow down the economy. And that chart just illustrating that we have not seen, once the data has been smoothed out, a big pickup in initial jobless claims, a big pickup in folks filing for unemployment. And another big increase that we got, or another change we got that was very meaningful, was Massachusetts removed a number of fraudulent claims from its unemployment data, and that led us to the biggest initial jobless claims drop that we had seen since 2021. Massachusetts said, quote, it was experiencing an increase in fraudulent claim activities, and unadjusted claims fell by more than 2,000. That's big for one state, in a state that's really not all that large. So labor market has only slowed down a little bit, even with 500 basis points of Fed rate increases. That's not a good sign for the Fed if what they want to do is slow down the labor market, which we know they do because they've said as much. Fewer layoffs mean the Fed rate hikes aren't working and the labor market is not weakening, which means, again, as we've seen, folks are spending on those credit cards and they're buying more things, and the inflation rate is not coming down the way they want it to. Listen, this all comes together in that consumers have more jobs, so they feel more confident in taking on debt, even if they can't buy things. Now they say, hey, we'll put it on the credit card. We're seeing declining loans from banks. We're seeing lower personal loans and lower loans to businesses. And we know the economy is slowing, but consumers are still spending. That's keeping inflation high. Fed has a big decision to make this week. The market is largely expecting that they're going to hold. We will see what happens at the Fed rate conference. And listen, that's going to do it for us here on Market Takes. I know you could have been anywhere in the world, but you were here with me, and I appreciate that. I'm Dion Rabouin for the Wall Street Journal. We will see you next time.